Hello and welcome to Portfolio Matters. Today in the My Worst Trade slot, I will be talking about my recent disaster in Bahamas Petroleum. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Well, the simple disclaimer for this one is don't buy it. But the proper disclaimer is everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, tell us about Bahamas Petroleum.
Thank you, Richard. Okay, so this is very topical because this was this week. Right, the conclusions to this My Worst Trade will be that when you're investing in speculative mine or oil companies that are exploring and have an asset that they need to develop or a hole they need to drill, an oil well they need to drill, you really need to pay attention to how they are funding that, because the way they fund it can completely change the risk-reward payoff for shareholders and actually can destroy shareholder value. The other thing is that whenever there is an event coming up, for example, the results of an oil well being drilled that are transformative to the company, then news is very likely to leak out before the news is announced to the market as insiders. So people, for example, on the drilling platform will know what the result is, and invariably somebody tells somebody who tells somebody and some shares get sold. So a way to find out what's going on is often just to look at the share price. And finally, internet chat rooms are actually amazingly useful in part because there are some people there who really know their stuff and are very well informed about the company. But at the same time, there are a lot of people who just want to believe. And so you'll find that in the days running up to the announcement that the well had turned out dry, they hadn't found commercial quantities of oil, there were people on the chat rooms spreading rumors that it was clearly a success because the minister had said this or various people were doing X. People want to believe, so be careful. Okay, so why did I get involved in this? Well, Bahamas Petroleum have been for the last 10 years exploring the waters south of the Bahamas, and they spent $120 million basically exploring and mapping and working out where they thought the oil was. And so the culmination of a decade's work was going to be the Perseverance 1 well, and that was targeting 770 million barrels of oil with a potential upside to 1.4 billion barrels of oil. If they hit that, the share price would go up, frankly, many multiples in a day. So that's your reward. So I bought shares at 2.8p in November because I like a bit of a bet occasionally. It's nice to have something in the portfolio that gives you, the potential for a nice uplift.
Yeah.
However, as Richard was explaining in his recent video on Soul Gold, which I hope you've watched, what really matters is the source of funding for these small exploration plays. And the cost of the Perseverance number 1 well was estimated at 24 to 28 million. So how was a small company like Bahamas Petroleum, which was producing a few thousand barrels of oil a day and is really quite a small company, going to fund a well whose cost is a multiple of its annual revenues? Well, there are various ways you could fund it. So surplus, number one, obviously, is surplus cash from operations, which is how BP or Shell would do it. But in the case of Bahamas Petroleum, that was not an option. The second and mainly the main way these companies fund operations is through a farm out agreement. So basically you get a much larger oil company to agree to completely fund the drilling of the well, but then you give up the majority of your interest in that well. So for example, in 2017, Chariot Oil and Gas had a 50% interest in the Rabat deep well off Morocco, and they farmed out to Eni, and Eni took the majority of that, leaving Chariot Oil and Gas with only a 10% interest in the well. So essentially they've given up 80% of their interest in the well in order to have it drilled, because otherwise they couldn't fund it. Another way is reserve-based lending, but then you have to have oil reserves, and basically Bahamas Petroleum don't have sufficient reserves, so that wasn't an option. There's drill for equity, but that was not an option in this case. And finally, there's what they did, which is dodgy equity financing, which is potentially highly dilutive to shareholders. And there you are dabbling with financing companies who will, out to make a quick buck and will give you very poor terms. So what did they do? Well, 1st November, they did a placing and they raised 9.5 million in the market by placing shares at 2p, and that got them some of the way there, 9.5 million, but they still need a lot more. And in the 10th of October, they did a convertible note placing with Australian investors for up to 10.25 million, convertible at 2p. But crucially, that was conditional on them having all the funding in place to drill the well. So if they didn't secure the last bit of funding, this bit of funding went away. So in November, they increased the size of that placing to 15 million. So you're getting closer and closer, but they needed to prove that they'd funded not just the drilling of the well, but the operation of the well for 2 years. It's because the financing agreement anticipated that there would be a lag between the exploration and the production, and that also needed to be funded. So then there was this £15 million subscription agreement with a fund controlled by Lombard Odier Asset Management. And frankly, I'd already invested by this point, and this agreement is very nasty, and we will go through it. So anyway, on the 21st December, the well was spudded and it was expected to take 45 to 60 days. Okay, so 3 days after they had announced their agreement with Lombard Odier, they issued a second regulatory news service update, which clarified the funding terms. Sorry, that's the next chart. Let's move on to that. So the agreement was with this 1798 Volantis fund, and the agreement basically stated that Lombard Odier, the Volantis fund, could sell their shares at 2.3p, and that Bahamas Petroleum would then be on the hook for the difference between 2.3p and the price that Lombard Odier was achieved in the market. So in the case that the Perseverance #1 well was a failure, the share price could then be expected to collapse. And Lombard Odier had the right to sell their shares 60 days after the spudding of the well. And they would then sell them into the market at, let's say, 0.5p. And Bahamas Petroleum would then have to pay Lombard Odier 1.8p a share to return the capital. So another way to look at this is Lombard Odier have lent them the money for 60 days. Over that 60 days, they will get a 15% return. So this is very high, essentially subprime lending. And this massively increased
50% or more, wasn't it, Keith? I mean, they limited the minimum return they could get was 15%. Had the well been successful, they would have got whatever the return was on the shares.
Precisely, absolutely right. Essentially, they received a put option. So they retained an option on their share price going up, but if everything went wrong, they could sell it back at 2.3p. So this massively changes the payoff ratio for shareholders. So what happened? Well, sadly, the well came out dry, which is, you know, one of those things, but the share price, under different scenarios, if they had had better funding, I would say the share price could have fallen to 1.25 or 1.5p, because Bahamas Petroleum still have other areas to explore. As it is, they fell to 0.65p.
So Keith, one question here: does this effectively write Bahamas Petroleum off as a company? Because even if they have other areas to explore, will they ever be able to raise the funding to do so?
Well, frankly, Richard, I haven't looked into that. There are still the company is still going, but as far as I'm concerned, they now have to give back a lot of the money that they raised from Lombard Odier, having spent a lot on the drilling program.
Yeah.
And that fundamentally weakens the company going forwards. But above all, the reason I bought this share was to see how the Perseverance #1 well was going to play out. And as it's a duster, my reasons for holding the shares have gone and get out. So I've taken my losses, which were, it was a small speculative play. They weren't huge. But anyway.
No, thank you very much for sharing that with us, Keith. Very, very interesting story, and actually an interesting insight into the difficulties of funding a well if you're a small company, and the pitfalls of being an investor in a small oil company.
Absolutely, because I think the point is, Richard, I'd already invested back in October, and then when they're issuing hundreds of thousands of shares at 2p. Inevitably, the share price is going to drift down towards 2p. The other thing I would say is that if the well spudded on the 21st of December and people were counting down from 40, you get towards 45 or 60 days and the well is going to come in. And as you'll see, the share price started to drift off. And on the Friday, before they announced the results, the share price fell 9.75% on the day, including this big sale of over 2 million shares right at the close at just over 2p. And frankly, that is a super bad sign. If you looked on the chat rooms, there are still lots of people saying, oh, it's a great success. And I was thinking, just look at the share price. Somebody is bailing out of this. But they bailed out at literally, 4:25 on the Friday. And unless you're really paying attention, you had no chance to kind of follow them out.
And interestingly, 2 million shares at 2p, that's only £40,000 worth of shares.
I know. Yeah, but absolutely.
Yeah.
So there you go. And so, although I don't really regret my punt on Bahamas Petroleum, I do regret the fact that the funding regime that was announced completely changed the economics of the well from my perspective.
Yeah. Well, thank you very much, Keith. I lost you for a moment there, but you seem to be back now. So a very interesting presentation.
Thank you. Well, thank you all for listening. I hope you'll press like and subscribe to the channel. And all that remains to say is goodbye from Richard Wheater.
And goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.